In this presentation, we will go through the open items for the simple method and adjust them. And for more accounting information and accounting courses, visit our website at accountinginstruction.info. In other words, these are going to be the questions that we had as we entered the data for the more simplistic method of the bookkeeping process, the more cash basis bookkeeping process we had. We're going to imagine that we have the answers to these questions now, and we'll be entering and making these adjustments to our QuickBooks system. We're going to open up our open items, the questions that we have had so far, and we're going to open up the QuickBooks file for the more simplistic, the more cash basis method here. So to open up the open items, we're going to go into the documents. We're going to go into the 2019. We're going to go into the January, and we're going to look at the open items reports for January, opening those up. Going to do the same thing for February. So I'm going to go back here to 2019. We're going to go into February, and we're going to imagine we did 2 months of data input as we have in this practice problem. It's been great. And then once we have those two open, we're going to open up the QuickBooks file. So I'm going to go back to the client folder. We're going to go to the QuickBooks data file, and we want to go into the QuickBooks 1, the more simplified bookkeeping process, and just double click on that QuickBooks file. We also should have a backup for you, which could take you to this point so you can follow along with us. Here we are in the QuickBooks file. We've got the home page open, the open windows open. You can open the open windows, go into the view dropdown, and the open windows list. We're going to now take a look at our open items and see what we can do in order to adjust them. This is how it would basically just be tracking the open items. So we've got January open items here, and we've answered some of these as we have gone. And now we're going to go back and adjust the rest of them. So first question, do we have an employer identification number? I'm going to assume that at this point we're going to say we have it, but we don't need it. Yes. Or we'll just say no, doesn't have one. Or that would mean that they're using their social security number. Now we could use colors to cross these out as we have before. If you're using Word, you can go up to Word and go to the Home tab, Fonts, and then Group, that's the font group, and then cross it out. That's another way we could do it. Business address, again, we probably have it. I'm not going to enter it at this point, so we're just going to keep going with the data. We're going to just enter the data. That's all they want, so we'll enter the data. And so then we've got the 50,000 uncategorized income. We've already adjusted that, so we've completed this one. I'm going to cross it out. 10,000 in uncategorized income. So that we can find. So let's go back into our QuickBooks file, uncategorized income. So if we then take a look at our two reports, balance sheet and income statement, go into the reports dropdown, company and financial, and we're going to go to the balance sheet standard and change the date range up top, customize reports, and we will change it from 01/01/19 to 01/31/19, and OK. Here are our adjustments. Now, most of these that are left are really part of the profit and loss, meaning that'll be the easiest place to find them because they're going to be in those uncategorized income and uncategorized expenses. So we're going to go into the reports and go into company and financial and profit and loss, changing the dates from 01/01/19 to 01/31/19. And really, we can just basically go into these two accounts, uncategorized income and the uncategorized expenses. And that's where most of our questions that are left over will be. And so even our open items, we don't even really need the much detail on the open items because we've entered them in such a way that we could just basically go into these accounts. And those are our questions. So let's go into the uncategorized income for this 10,000. And here's the 10,000 that was on our open items. 10,000 is an uncategorized income. So what we're going to say is that uncategorized income, we asked about it. That was, of course, a result of a deposit that was put into the checking account, and it looked unusual. It was larger than other deposits. It's an even number. So we thought, that might be something funny. We're going to say that came from the owner. So it was an investment from owner. Okay, so that's an investment from the owner. So I'm going to go back to QuickBooks, and we will then say This deposit then needs to be recategorized. So I'm just going to double click on it. That's why we put it here. We knew that was going to happen. And then this is a deposit screen, this uncategorized income then. We're going to change it as we knew we would. Now knowing where it would go, as we kind of guessed it might go, is going to be to the owner investment. Now, the owner investment needs to be some kind of equity account, and this will happen from time to time. Usually the owner will draw money out, hopefully, because that means the company is making money, or the business is making money, and the owner is taking it out of the business for personal use. That's what we would expect. The investments into the company aren't going to happen all the time. They'll be more periodic. So in other words, what we typically do is we'll see a draws account that will track out the money that has been taken out from a periodic standpoint. But we don't always make another one called owner investments, showing the money that's going in. Oftentimes we just put it directly into the equity account. That's what we'll do here. So if you want to see what the owner put in, then you'd have to go to the equity account and look at the detail. So let's see what that would look like. We're going to put it to equity, and we're going to say save and close, and yes, and okay. It's going to say you're doing it to an equity account. Do you really want to do that? We're going to say yes, we do. And then now it's out of here. Where did it go? It went to the balance sheet. If we update the balance sheet, it's in the equity. So it's not broken out in equity. It's just kind of going to be grouped in with the equity account. If we double click on the equity, then we'll see the detail in the equity account. Normally you won't have much in the equity account because really it's going to be a rollover of the net income. Here we have the beginning balance because we started the company, that's the bank account, and then we have the investments. So there shouldn't be much activity in equity because really equity is going to be the rolling over of the temporary accounts. The net income will eventually go into equity. So we'll close that out. Back to our reports, we're going to go back to our data here and see what else we have. This one we have found, so I'm going to go ahead and cross that out. Then we're saying, who is Epiphone? Are they a vendor your purchase inventory from? So Epiphone, we had these checks for $1,000 on January 1st and on January 28th. We have these checks for check number 1,400. Who is Epiphone? We don't know. That's a vendor. We didn't know where to go with it. And we know that what type of business they are because we interviewed them. They said that they sell guitars sometimes, and they do guitar lessons. So we're gonna say, Epiphone. We looked it up. We can do an internet search, and we saw that they're like related to guitars. So maybe they're buying guitars from. Is that a vendor? Are you buying and selling guitars? That's our guess. We're gonna say, yeah, that's what they say is happening. These are a vendor. They're purchasing guitars from them. Now, this is going to be kind of our tricky one, and it's kind of why we avoid, under this method, using inventory, tracking inventory, because we've told them up front, hey, you know what we're going to do is we're not going to track that inventory very specifically. What we're going to do is basically write it off because we're on a cash basis system at the point in time that it clears the bank. So in other words, if we go to the profit and loss now, we're just going to go to the uncategorized expenses, double click on it, and anything that says that it's an Epiphone, we're going to assume it's a purchase from Epiphone of something that they're going to then resell. And that's what they've been telling us. That's what they're telling us. It's a $400. We're going to purchase. They purchased a guitar. We're going to say for $400. They're going to resell. We're not going to do what we should do, which is put it on the books as an asset and then sell it expense it when they sell it. And we're assuming it happens pretty close in time, hopefully, for this system to kind of work. What we're going to do is just write it off on a cash basis when it was paid for. And so we're just going to go into anywhere there's an Epiphone, double click on it, and change the uncategorized to an account like cost of goods sold. So cost of goods sold for merchandising account fees, product sample, purchase, and resale. So it's a purchase, resale, cost of goods sold item. That's what we're assuming every time they're going to hit Epiphone now. And again, when they purchased it, that they didn't necessarily resell it at that point in time, but it's a cash basis process. So that's the assumption that we're making, that they're selling it pretty close to that point in time. And that's what we're doing in the cash basis process. So we're going to say save and close. And there we have that. If we go to any other one, here's an Epiphone. We're going to do the same thing, double clicking on that. We'll change this once again to a cost of goods sold type account to the resale purchase resale items. We're going to say save and close. And there's that one. Here's another Epiphone. Same thing. I'm just going to double click on it. And we're going to change this uncategorized to the purchases. And save and close. So if we go out of here then, all we've done is moved it from the uncategorized up here to cost of goods sold. So it's still an expense, and it's going to be matched up. It's going to reduce net income, but we're assuming now that we're not tracking the inventory. We are still expensing it at the point in time it was purchased. And so we're assuming that they purchased it and then resold it fairly quickly if we're trying to be close to an accrual basis there. So that's going to be that item. And so we'll go back to our open items here. We're going to say that is this one. We're going to say the same thing is the case for Gibson. We're going to say, who are they? And they're going to say, oh, they're someone I purchased guitars from. And then we resell them. Okay, so I'm going to cross that out. Same thing. We'll go back over here to our QuickBooks and we'll go into the uncategorized. Double clicking on uncategorized. Anytime we see Gibson then, here's 500 Gibson. Double clicking, once again, changing this to purchases. And then we're going to say save and close. Any other Gibsons? That's it. So that's that one. So I'm closing this back out. We put that into the cost of goods sold. Going back in over here, that's Gibson. Safe insurance, we already dealt with that. The green ones we've dealt with. Office Depot, we've dealt with that. There's a Vanguard account, and Vanguard is often something we invest in, an investment company. So we're guessing, is that $15,000 like an investment or something like that? And they're going to say, yeah, we invested, we took some of the money, too much money we had that we're not going to spend right away, and they put it into an investment. We don't see this all the time, but you might see this within a company file. So they took it, they put it into in other words, to like stocks and bonds. So we're going to say, okay, we're going to take this out of uncategorized income, once again, Vanguard, and we're going to put it, this one we have to make an asset account. It's not an expense. It's going to be some type of asset account. So I'm going to double click on it, and we're going to change this from uncategorized to some kind of asset account. Now, if we go up to all we have is a bank account and the fixed assets. So we're going to have to add an asset. We just might call it just investments. So some type of account that's just investments, stocks, and we'll set that up. I'm going to select tab, and then we're going to set that up, and we're going to create it as an other current asset account. So it's an other current assets type of account. And that's going to go on the balance sheet then and say continue. Other current assets, investment, that's what we want. We're going to say save and close. And then save and close. So we'll keep that change. So now it's been moved out of here. That's a big one. Closing that out. This is making the income statement look more appropriate now. And we're going to go back up to the balance sheet. And we now have an investment of the $15,000. So that's now an asset because we're holding on to it. It's our investment account. So let's see what else we have over here. We're going to go back to this one. Vanguard has been done. And we're going to go to the hot air balloon. So if we look at that one, we're saying, hey, you know, that doesn't look like a business expense. Now, again, they might have had some kind of business party at the hot air balloon. They did some kind of business related thing there, you know, related to guitar. Maybe they had a rock concert or guitar lessons in the hot air balloon. But it doesn't look like it. So if they told us, hey, yeah, that one's not a business related expense. And again, it's not our job to really to tell them what should or should not be. We can give kind of some opinion, but that's up to the tax professional or financial statements. We're asking, hey, is that part of meals and entertainment possibly, or is it a personal? This one, we're going to say that he says it's personal. Okay, so we're going to go back over here, and we're going to say he paid for something that was personal, he or she or whoever, profit and loss, paid for something out of the checking account, business checking account that's personal. Okay, so we're going to go into uncategorized, and we're going to go into the hot air balloon, and we're going to change this to some type of equity account. It can't go on the income statement. And typically we're going to go to draws there. So this is just like if they took the money out personally as a draw and then paid for the hot air balloon. They just skipped the middle step. They just paid for the hot air balloon out of the company file. So what we're going to do is just take it to draws here, which will, so now it's in draw. Let's see what it does. Save and close. And now that'll take it out of here. So it's no longer on the income statement. And you can think about that for taxes and just look, you want to think a little bit about what your client's incentives might be on why they might, think one way or the other. They might want to try to put more expenses in here, or they might try to be guessing, how can I increase the expenses? Why? Because that would lower net income for taxes. That might be a thought that's kind of in their mind. And again, it's not our job to really say one way or the other, but it's good to just have an idea of what might be driving how they would categorize one thing or the other. Or they might be trying to get a loan or something like that, in which case they want net income to look good, in which case they might be trying to lower expenses possibly further than should be the case in order to qualify for a loan or something like that. So notice there's pressure on both sides when you're for the business owner to want to have their net income high, because that makes you look good for loans and things like that, or low because that makes you look bad, which is always nice when you're going to Mr. Tax Collector. You don't want to go there looking like you're doing good. So you just keep those two kind of incentives in mind. Your goal isn't to advise on those things, but just keep them in mind as reasons why they might feel pressure to want to expense things or not expense things, and keep in mind that you can just ask them to get advice from the professionals on those. So if we go up to the balance sheet, whatever they're looking for, if it be a loan or if it be the tax professionals on categorizing these things, and we want to enter the data as consistently as possible and as correctly as possible here according to what is given to us. So here it is in draws now. So it's in draws, so it's on the equity section. It's not part of income. It's just going to be like he took money out for personal use. He or she took money the owner took money out for personal use. So now we're going to go back to the profit and loss and see what else we have. What else do we have? That one is done. And then we're going to say Wild Bill's House of Ribs. And again, we might say, that seems like it's, I don't know. But if they took clients there, maybe it's a business expense. So maybe they're saying that the restaurants are going to be business expenses. And this is a question that's a legitimate question. It happens all the time. And that's not really our domain to look at. We know that we do know that restaurants are kind of that kind of thing. If it's just a normal meal in the middle of a day, even though you're working during that day, probably shouldn't be a write-off for taxes if that's what the goal is. If on the other hand it's a business lunch, then those are going to be the differentiating factors. But not our job to really go into those. You want to say, that's a tax professional. They tell us it's a meals and entertainment or something like that. We're going to say, okay, and go into this category and say this is an expense, and we'll re-expense it, double clicking on this or move it from uncategorized to something like meals and entertainment. It's already set up. We don't need to set anything new up. It's not unusual. We don't need to say this is, an unusual new account. We'll just pick meals and entertainment, the one that's appropriate for the list of accounts given by QuickBooks. And we'll say save and close, and close this out. So there we have that now. So we've entered that one and just moved it to meals and entertainment right here. And that is done. And we've already done the Visa card, and we've determined that these are employees. Now we're going to go to the withdrawal of $300. And so if we go back to QuickBooks, and we go into the uncategorized, there's 300 left. We're going to say, well, he says that that's going to be either business or professional. Either he took that out, the owner took that out and put it into something business related, bought something business related, or they took it out for personal. We're going to say this time that he says that is going to be a personal expense. Therefore, we'll put it into, once again, the draws. So this is the more proper way to do it, really. They took money out of the business and then spent it personally. So we would call that, okay, they took money out draws, and then spent it on personal whatever. So then we're going to say save and close, and yes. So if we close this out, it's been removed from here. That goes to the balance sheet as the draws. Now we can do the same thing for February, which should go a lot faster. Same kind of thing. Ted's Steakhouse, Epiphone, and Visa. We ask about these with the vendor. So let's go through these ones, and some of them will be repetitive now. So if we think of the second month, we're going to go, okay, now let's change the date to 02/28/19. 02/28/19. Here's the balance sheet. If we go to the profit and loss and we change the dates from 02/01/19 to 02/28/19, there we have that. And now we're going to go back to these same items. We don't have any uncategorized income. We've got the uncategorized expenses. Double clicking on that. We've got Ted's Steakhouse. And once again, we're going to say that we asked him about Ted's Steakhouse, and he says that this one is going to be meals and entertainment. And sometimes we can look at these and they'll be the same all the time. Other times they might change. So if we always see a restaurant and our client is good at basically putting the restaurant in either business or personal, then that's good. If we have a client that has some restaurants that they say are business and some are personal, then we need to get some kind of system and see if we can clear that up with the customer, and possibly ask them, the client, hey, it'd be a lot easier if you just put the business expenses on the payment, whether it be a credit card or the expense account, and do the personals elsewhere, so that we don't have to ask you, whether it be business or personal. So on this one, we're going to say meals and entertainment, double clicking on this, and we're going to just change it to meals and entertainment, and save and close. And then the Epiphone, we already know that that's going to be a guitar, a purchase, so we'll double click on that. And so now we can basically go through these and know, based on the prior questions, purchase and resell, that's going to be cost of goods sold, we're going to say. Save and close. And then the state sales tax. Now we're going to say that here, what is that? If we ask them, there's a state tax. Now that could be it could be sales tax, it could be income tax. We need to basically recategorize it. It's in some format. We're going to say here that this one is sales tax. Now note, again, we're dealing with someone with inventory that may have sales tax or usage taxes, and that's a more complicated system, and that's another reason we may not want to be picking up the clients that deal with the inventory, whereas because if we had a service company, we may have less kind of sales tax or usage tax to deal with. But that's another area we could think about wanting to pick up and make the sales or usage tax portion, because that's different from income tax. We might still be able to have some differentiation between filling out those kind of reports if we want to pick that up, as opposed to the income tax, which we can have the tax preparers or professionals separate those duties. So in any case, we're going to double click on the state sales tax, and we're going to say that this one, we're going to start a new account. It's going to be some kind of tax here. Let's make an account called sales tax expense. We're going to say sales tax expense. Now note that if we were tracking sales tax, then QuickBooks has kind of a method for us to do so, but we're on a cash basis, so we're not really doing that. We're basically writing off the sales tax as we go, as they're incurred. So we're going to say next and set it up. It's going to be an expense type of count. We're going to say continue and save and close. So that'll be the sales tax. And all it did was move it out of here and add a new account. If we go back out, which would be the state sales tax, which is here, sales tax expense. Okay, so if we go back into uncategorized, we're going to say now we have the internal revenue service. That's going to be the income tax. Now we might have a question in terms of, is this your personal income? And because it's a sole proprietor, it may be. It's probably the personal income versus the business income. So we kind of have a question here, where do we want to put this? Do we want to put this on the income statement, or do we want to put it on the balance sheet? Now if it's a sole proprietor, it's probably not going to be something that's going to be deductible. So if we're entering this information that's going to be for basically tax preparation purposes, we might want to put it on the balance sheet, because really this internal revenue, this income tax that was paid, is on the 1040. Even though this is part of the 1040, the income for it, it's not going to be something that will typically be deductible. So we might want to just put this in as draws. If we're saying, hey, is this the tax paid on the 1040? Then we might just want to put that on the balance sheet as draws, as something that was paid out of the business for personal use, for the draws. If we put it into the income statement, then we could put an expense account called income tax expense. We could do that and then probably depend on the tax preparer at the end of the year to pick that up and say, that's not deductible. As they put that into their system, they're probably going to go, maybe that's not something that should be there. So you can really put it in either spot, an income tax expense, or into draws, depending on the company. Now, if it was a different type of entity, like a S corporation or something like that, we might have more questions as to whether the expensing of the tax would be appropriate. And we might have questions in terms of, is it for bookkeeping purposes that we are entering this, or is it for tax preparation purposes where we could have differentiation? So here I'm going to go ahead and put it into the draws account. So we're going to double click on this, and we're going to go to uncategorized, and I'm going to put it up into the draws equity draws. And now again, just note that if you want to differentiate and you're not sure, then you might just make an expense account called income tax expense, and that way it's more visible. So if it needs to be, something needs to be done with it, whether it be taken out or added, it can be done so from the tax preparer because it'll be more visible there. If you don't want it on the income statement because it's distorting net income, then we can take it out and put it into draws if it's going to be considered personal. So we'll save and close. And then the last one, and so what that did now, if I close this out, is it took it out of the income statement entirely, because we're going to say it was taxes paid for personal taxes and not the business necessarily. And then if we go back up here, then where did it go to? It went to the draws account. Going back to the profit and loss, we're going to say we got 300 now. The second one, we're going to say that it was a withdrawal. For the second one, we're going to say we asked this time, and they say that it's business related. So they took money out, it's business related. They may not give us any more detail than that though, because what did you spend it on? We don't know, possibly because it's money, it's just cash. So we can say, okay, they took the money out. We can put it into like, oftentimes office supplies would be something that we can put it into if they say they took it out for business purposes, but we don't have a specific account. Or we might just create an account called miscellaneous account. And this isn't the best account to use if it becomes large, because it can look kind of funny. If there's not too much in the miscellaneous account, not really a problem. But if you have a miscellaneous account that's like your biggest expense account, then that's not good because it draws attention to it and it's not categorized anywhere specifically. So people might start to say, well, what is miscellaneous if it's really large? So if there's small items in there, not too bad. But if it's not, then you want to put it somewhere else. But the same goes anywhere. If you put it into office supplies, and office supplies usually being small purchases, and small purchases starts to be your largest expense account, then that also looks very conspicuous. People might, the IRS, for example, may ask questions about what exactly you put in office supplies when it's greater than any other expense account that's there. So just note that the best thing to do is, once again, if we had the discussion, our preference with the client would be, hey, don't take cash out if you can avoid it. If you're spending on the business, try to write a check, because then the audit trail is there for us to categorize it more appropriately. That would be the easiest thing to do. So in any case, we'll save this. There it is. And save and close, and save and close. Okay, so there we have it. If we close this back out, now we've got our income statement is looking appropriate here because we've gotten rid of those uncategorized accounts. And if we go into all of our information here, it looks like we've cleared everything off. So that would be the way we can kind of look at this now. And now notice how easy it is for us to just basically go back into those uncategorized funds, uncategorized accounts, income and expense, and then just reallocate those based on the questions we have answered now. And as we go forward, now that we'll have much less work to do with regards to those, because we won't have as much uncategorized. Bottom line is if we go to 01/01/19 to the end of the time period, January through February, the 2 months we've worked on, then we have no uncategorized expenses and no uncategorized income, and therefore our net income looks more appropriate now. And now it's still a loss, and we'll talk more about why that is. One reason is because we've got the insurance here, which is really for an entire year, and we entered that on the simplified method. But this looks more like an income statement. So next, let's do the same thing again in the more complex bookkeeping. We'll do it a bit faster, and we'll take a look at some of the differences between these two accounts. For more accounting information and accounting courses, visit our website at accountinginstruction.info.